I'm Valroy Binsbacher,
And I'm Maury Griffith.
and we're going to do on this DVD a run-through of your trust and will. Now, by the very nature of this, it's being done for all of our clients, so we're going to be general in nature, but we're going to try to cover the key points and cover some of the theories behind your documents. So we're going to begin with the trust document. So if you'll pull that out of your packet, you should have that with you. You may have a red pen. Feel free to mark on the document questions that you may have during this review, and then you can cover them with us or one of the staff members here in the office. So with that.
So the first thing we want to cover is that we have your name correct in the document. So take a look at the very first page of the document, which is entitled Declaration of Trust at the top. And it should say Declaration of Trust of, and then your name should appear. Make sure we have your name spelled correctly. And then in the first paragraph, it should say I, your name should appear, and then your address should appear. Make sure all of that information is correct. Then it says you hereby transfer, assign, and set over to yourself as trustee and declare yourself the trustee of any and all property and all investments and reinvestments and additions thereto that are titled or funded in the name of the trust to be administered as follows. What that paragraph basically is saying is you're going to be putting assets that you own into your trust. And any of those assets that go into your trust now or in the future are going to be trust assets, and they're going to be administered in accordance with the provisions we're going to walk you through. So that's the first paragraph.
May be important more for them to remember, we refer to that as funding.
Yes, we do refer to that as funding, and you'll see there on the last line it says titled funded. That second part is funded, which is funding, and that means just putting assets into your trust. And you'll note that when we get to the point of signing your trust, then immediately following you're going to go through a funding meeting, and we're going to explain to you how to do that process. The first paragraph then, or Article 1, is called Trust Name. And under your trust name, it says this instrument and the trust hereby evidenced together with any amendments may be designated, and your name should appear, followed by declaration of trust dated, and it should be blank. It's blank at this point because we don't know what day you're going to be signing. Now, if we already have your signing date scheduled for some reason, then that date would be filled in and make sure that would be correct. But when you get to the point of signing, it should be blank now, but when you get to signing, that will be filled in and completed when you come in. Article 2 is lifetime rights. Under Article 2, this is basically how the trust is going to be administered during your lifetime. So Article 2A says, as long as I am able to manage my financial and business affairs and decisions regarding administration of the trust property, the trustee shall pay such part or all of the income and principal of the trust property to me or otherwise as I may from time to time direct. So basically what that's saying is you are in control of this trust during your lifetime. You direct how money is put in, things or assets or money are put into this trust. You direct what comes out of this trust. You direct income, you direct principal, you direct everything. You're in charge during your lifetime. It continues on to say that if my attending physician states in writing that I am unable to properly manage my financial and business affairs, the trustee shall distribute for my benefit and for that of my spouse so much of the net income and principal of the trust as the trustee believes desirable for the support, comfort, companionship, enjoyment, and medical care of my spouse and or me, taking into consideration all the resources available. So basically what that's saying is if for some reason you become incapacitated and you can't manage your own affairs, then whoever you've named as a successor trustee, which we'll get to later in the document, is going to manage the trust for you. And they're going to pay out as much money, income or principal, as they think is necessary for you and your spouse to take care of your needs. So that's the way the trust works during your lifetime. There may be an optional provision that you have in your document next under Article 2B. And this is an optional provision related to gifting. And some of you have it, some of you don't. If we've talked about gifting in our meeting and you've told us that you want to include it, then this provision should appear. If you don't want to include it, then this provision would not appear, and you can just wait until we continue on with the rest of the document.
And they may still be deciding.
And yeah, you may still be deciding, and if so, I'm going to explain to you what the provision says, and then you can make a decision after you hear this about whether you want to put it in your document. So under this provision, it says generally that if you become incapacitated, then during that time of incapacity, the trustee may make annual exclusion gifts and tuition and medical gifts to any one or more of your descendants and their spouses in amounts the trustee considers appropriate. It later goes on to say that gifts permitted under this paragraph are not going to exceed the annual amount for that is set by the IRS. So basically what that means is every year the IRS sets the amount of gifts that any person can make to any other person. It's usually indexed for inflation, but we would have discussed for you or can discuss for you what the amount of gift is in the year that you're looking at this video. But basically what it says is you can make general gifts limited to that amount, and you can make tuition and medical gifts. A tuition and medical gift is kind of just like it sounds. If it's a gift that you're making directly to a university or a college for somebody's tuition, then you're not limited to the IRS annual limit. You can go over that. And if you're making gifts to a hospital or something like that for somebody's medical care, you can also exceed the annual limit. But generally speaking, unless it's related to one of those two things, you're limited to the annual IRS limit, and this is giving the trustee the power to make those gifts while you're incapacitated. And that leads us to the death provisions.
Okay, the death provisions, there's several that we have to walk through. And the first is the payment of expenses. Now, many clients will chuckle about this. It's not something that you necessarily want in your documents, but it's something that is required. Under Roman numeral 3, letter A is where I'm going to begin, and you'll see really two parts there. The first part, which is small letter A in that large paragraph, or the uppercase A, is saying the trustee may pay the expenses of your last illness, your funeral, your debts, that sort of thing. So it's within the trustee's discretion. The second part, which is small letter B, is to pay the taxes. Whatever the taxes might be, whether they're income taxes or some sort of death or transfer tax, you're directing the trustee that the trustee has to pay those. The reason we like to put in that the trustee may pay your funeral expenses, debts, and so on, is that gives the trustee some latitude to negotiate those bills, make sure that they're valid, make sure that they are things that should be paid. Letter B, the trustee may enforce all rights to recover federal estate tax provided under Internal Revenue Code sections, and you'll see several sections there. What we're trying to make sure your estate, your trustee has the right to do is there may be property outside of your trust that generates taxes, and you're authorizing your trustee to enforce the rights of your estate to get the tax paid by the individual receiving it. So a quick example, if you have life insurance that's payable to someone outside of your trust, that person is going to be asked to pay the taxes that are attributable to the life insurance proceeds. Letter C, the trustee can certify to the executor or the administrator of the probate estate the extent to which he doesn't have enough money. The trustee says, I just don't have enough money to do this, so executor, you're going to have to pay it. Now, we hope that provision is never needed in your estate plan, and if you follow our advice, it's not going to be needed because you're going to have all of your key assets, your assets of value in your trust. But in the event that there's something that is inadvertently left out, that money will be accessible to pay debts and expenses. And letter D, we're saying that the taxes and so on, the expenses, are ratably apportioned. So if Maury, for example, in my estate is getting 40% of the estate, he's going to pay 40% of the taxes and expenses. So we're going to ratably apportion those. Letter E is kind of refereeing between your trustee and your beneficiaries. You're saying that the trustee has the right to make elections under the tax laws. In other words, what should be deducted, what should be expensed, those sorts of things. And you're saying that he has to take the interest of the beneficiaries into account, but the trustee is making that election. Then gifts at my death is the next Roman numeral. And this is after those debts and expenses are paid, we've decided who is paying what, the trustee's taking care of all of that, and the trustee is now looking at what am I supposed to do with what's left of the trust. The first thing that you say is, if I have something in writing, a document in writing that says where certain personal property things are going to go, including my will, I want the trustee, if the trustee is holding that asset or the assets necessary to make those bequests, I want the trustee to go ahead and pay those. So quick example, if I say in my will I want all of my farm equipment to go to a particular son of mine, and at my death my trust is holding the title or the bill of sale for all of my farm equipment, trustee is authorized to go ahead and give that to the son. So that can be a key provision so that you don't have your executor and your trustee scratching their head and wondering, what am I supposed to do? So it kind of clears things up for them. Then you go on to say, if my spouse survives me, Then I give the balance of the trust estate to my spouse, we're calling that the marital gift, to be held as part of the marital trust. Now, that's something we talked about in our meetings with you, and you should have a pretty good understanding of that. But in other words, after you've dealt with personal property, you're saying, my estate's going to my spouse, that's the marital gift, that's the marital deduction, anything you're leaving your spouse is tax-free, and that is important for you to realize. But there's an important provision that's contained in that marital gift. It goes on to say, but my spouse may disclaim a part of it. Well, by disclaiming, your spouse is saying, I'm not going to take full control of this asset. And where is it going to go? It's going to go into the family trust. And we'll be talking about that in just a moment.
When does this disclaimer have to occur?
Very good question. It has to occur within 9 months of the date of death. So there's all sorts of technicalities there, Maury, as you know, and we really have to watch that closely. So you're going to need coaching to do that. But one of the key things that you have to realize, you can't take a benefit in something you're going to disclaim. The disclaimer is, in essence, saying, I want you to treat this asset as if I died before my spouse. So if you died before your spouse, obviously you couldn't have benefited from that asset, so you can't accept any benefit. And it can be something as simple as you take a payment on an annuity. You don't want to do that if you think you might be disclaiming. So again, that's something you're going to be talking about in the event of the death of your spouse. It's something you're going to be coached on. Now, if my spouse does not survive me, then the balance of the trust estate shall be held as part of Article 6B, which is going to be the family trust. But let's talk about that marital trust first. Anything that your surviving spouse chooses to leave in the marital trust under the marital gift, or any amount that is there and is being held for your spouse, can be used for the spouse, for your surviving spouse, in any manner you can imagine. All the income, all the principal, anything can be used. Your spouse is going to have the right to write a will and leave it to whomever he or she pleases. They have full control. There is a provision that you're going to see probably at letter B that says your spouse has the right to direct a trustee not to hold unproductive property. That's something we have to put in there because of IRS directives. And it's something to keep in mind only if you have something that you consider a major asset that's not very productive. Like timber property, for example. You could have timber property that generates income maybe every 10, 15, 20 years, but in between it's just not really producing any income. So your spouse would say, that's okay to hold that, that's fine. Now, Article D takes a little bit of thought. What you're doing here is, you're saying, for purposes of this article, my spouse shall be deemed to have predeceased me or survived me if there's no sufficient evidence that we died otherwise than simultaneously. What we generally do, and this is something we look at the asset information you've given us, and we usually pick the spouse who has the most assets as having died first. Now, if we have it basically equal, we just pick one, and that's something that Melissa does as she's preparing the documents with us.
Now, it's important to note that in your documents, they should be opposite. So if the husband is looking at his and it says predeceased, then the wife's should say survived. So just make sure they don't say the same thing in that sentence.
If they do, then let Melissa know. Melissa probably just missed that. Family trust. The family trust, keep in mind, if you are the surviving spouse and you've disclaimed assets from the marital gifts, this is where those assets are going to go. And it's a little different than the marital trust. Remember what I said a moment ago, in the marital trust, the surviving spouse has full control. The family trust, you as a surviving spouse, you do not have full control. But let's look through this. Letter A, commencing with my death and until the death of my spouse, the trustee shall pay the net income of the family trust to my spouse, and after the principal of the marital trust is exhausted, so there's nothing left in the marital gift, and not before, so much of the principal thereof as the trustee from time to time believes desirable for the reasonable support and health care of my spouse and my spouse's accustomed manner of living, considering all other resources available to my spouse for such purposes and known to the trustee. This has at times caused surviving spouses to cringe a little bit, and maybe that's an understatement to say cringe a little bit.
Yeah.
as a surviving spouse, when you first hear that language, you can feel like you're being restricted a little bit. But that's why we want you to pick trustees that you have confidence in, as we discussed in the meeting, so. Now, upon the death, you don't have any control as a surviving spouse as to where this is really going to go at time of death. And typically, you're going to see equal trust to your children, equal trust as to nieces and nephews. In other words, your class of beneficiaries are going to get equal trust. If, however, during your drafting meetings with us, you've talked about, well, I'm going to have this farm ground going to this child and this farm ground going to this child, and you know it's going to be unequal, then you probably just see this being divided into trusts. And it also may cover what happens if a beneficiary dies before me. So for example, I might say, in the event my wife does not survive me, or my wife survives me, then my family trust is ending. I want it to go to my sons, but if a son dies before me, then on to his children. So a descendant type of trust is then set up. And then the children's trust, so we've gotten through the marital trust, we've gotten through the family trust, we've gotten through the second death of the two spouses, and that's where I want your thinking to be at this point. So both of you have passed away, the property has been divided up among children, and there's two types of children's trust that we typically see. One is what we call immediate rights. Once everything's taken care of it, as far as debts and taxes, your children have it, they can take it out of trust, they can leave it in trust, they have immediate rights to do whatever they want to do. Other times, and I'd say it's almost becoming the majority of the time, the age restrictions.
Mm-hmm.
Right now, for example, in my trust, I have at the age of 45, and a lot of you know that, I've talked to you about it, for our sons. That means they're going to get income, perhaps, if I've said that's okay, and they're going to get principal for the reasonable support, education, and health care of the child, considering other resources that the trustee may know of. Now, to me, that's not really causing any problems for my sons or your children if you chose age restrictions. They can have it for support, they can have it for maintenance, they can have it for education. It's just that they're not going to have full control. They're not going to have the property taken from them. They're not going to be duped out of it. They've had a lawsuit of some sort, that sort of thing. They're not going to lose it. And Illinois courts have said, if there's an age restriction, your child hasn't attained that age restriction, they can't lose it in a lawsuit. So they don't really own it, they can't lose it. Now, if you have a trust for your children, you're going to say either immediately they can write a will, or at a particular age, they're going to have the ability to write a will. So it just depends on which course you've selected there. And if they don't write a will, it's going to go on to their descendants, and we're going to have a provision for them later on. So that's kind of the way the children's trust works. Anything to add there, Maureen?
No.
Okay. And we're ready for administrative clauses.
So the next article, and the numbering may get a little different here depending on what you've done with respect to handling and treating your children. In my document, it's Article 8. In yours, it might be something different, but look for the one that's entitled Administrative Clauses. That's where we're at. And certain times throughout this trust document, we're going to skip over some provisions because they're not really relevant for us to talk about, but they're necessary technically in the document. I'm going to skip over Article 8, Administrative Clause A, and go into B. And that one says, any property otherwise distributable under any prior article to a beneficiary who has not attained the age of, and we would have filled in the age there if you provided it to us. If you're still thinking about what age you want future beneficiaries to get their share, then that would be blank for you to think about and tell us. Blank years, and for whom no trust is then held hereunder shall be retained by the trustee as a separate trust, and the trustee is going to distribute so much or all the net income and principal of the trust estate as the trustee deems advisable for the support, maintenance, health, education, welfare of the beneficiary. And then it goes on later to say when the beneficiary attains the age of whatever you've told us, the trustee is going to distribute that trust to the beneficiary, and if they died prior to that age, then they're going to distribute it to their estate. What we're saying here is, if you've said, if a trust, for example, is going to be created for someone you haven't already mentioned, for example, if you said at the second death of us, everything goes equally to our kids, then we're talking perhaps about a grandchild. If one of your children would die and their share is going to be distributed to their children or your grandchildren, this is the provision that would kick in and say what age your grandchildren would get their share. They're going to get income at a certain age and principal at a certain age, and if they die before that, it's going to be paid to their estate.
So that would be what I was talking about a moment ago. If a child hasn't written a will saying where their share is to go and they die while something's still being held in trust.
Right. So yeah, that's a great point. If you've given your children the right to write a will and direct where their share is going to go, and if they've done that, then this provision is not going to be effective for that. But if they haven't done that, or if they did it improperly, then this is where this provision is going to kick in and handle the distributions to your grandchildren.
So the ages we're looking for there are ages for grandchildren more than likely.
More than likely, it's going to be grandchildren ages. So you have to have thought about and told us what age you think a grandchild should get their share. Article C, or Article 8C, it says that basically if you're going to be making payments to somebody like a grandchild, for example, then we number item some ways that the trustee can do that. In C1, it says they can make those payments to the legal guardian of that beneficiary. So if they're a minor, the trustee is authorized to pay it to their parent or guardian. They can pay it to a relative of the beneficiary to be expended for that beneficiary if they think that's appropriate. They can pay it to a custodian, or they can make the expenditures directly on the beneficiary's behalf. So they've got a lot of flexibility in how they pay that trust out to the underage beneficiary. In Article D, the next paragraph, we're saying that no interest under this agreement or this trust is going to be assignable by any beneficiary or be subject to the claims of his or her creditors. Now, a lot of people read that and think, in your situation, that this means that your trust is protected from your creditors. It isn't. We cannot write a provision in your trust that's going to protect your assets in this trust from your own creditors. What this is designed to do is kind of go along with what Roy was saying a little while ago about protecting your beneficiaries. Basically, this is indicating that if a beneficiary gets divorced, that any assets that are held in this trust for that beneficiary are not going to be included as a part of that divorce. The beneficiary's creditors can't come in and say, give me this money out of this trust. It's basically designed to protect the beneficiaries from things that are happening in their own lives, but it does not protect you from your own creditors. In E, that's basically a provision that we have to include. It basically gives a final ending date for your trust. And basically what it says is 21 years after the last person to die, after the two of you die and all of your beneficiaries die, count 21 years after that, that's the final ending date of the trust, and we're going to then distribute it to whoever is entitled to the money so that this trust doesn't go on forever.
And by your provisions, it's not going to go on forever anyway. It's just a state requirement that we have to have that in.
Right. Article F, the next article, basically says that if someone's going to be acting as a trustee, they've got to be competent in order to act, and if they're not competent, they're not going to be able to serve as your trustee. The next article in my document is G, basically talks about accountings. It says upon written request, the trustee shall send a written accounting to basically all the beneficiaries of the trust. They can send it to the present beneficiaries or what they believe to be future beneficiaries. And if someone doesn't take action on that accounting, in other words, start a lawsuit saying that the trustee is handling things incorrectly within 3 months, then that accounting is deemed to be binding. So it gives your trustee some finality. When they account to all the beneficiaries, they say, here's what I've done, here's the income, here's the expenses of this trust. You have 3 months to say that you have a problem with this or start a lawsuit against me, and if you don't, we're all going to say that that's okay. What I've told you is binding on you. Article H says before distribution of any trust principal, the trustee has the right to settle any open accounts. Again, that's just a provision to protect the trustee, saying that I don't have to start making distributions to the beneficiaries until I've handled all the debts and all the things that might be open and pending. The next article or paragraph says that if a beneficiary is under disability, the trustee can give the accounting or any notices, that sort of thing, to their parent or someone who's demonstrated a concern for that beneficiary. So that if you've got a minor, for example, it's a way of giving them notices and giving them accountings. And then the next article, the last paragraph in this section, says that for all purposes under this instrument, which is your trust, legal adoption, single or successive, whether it's lineal or collateral, shall be the equivalent of blood relationship. Now yours is either going to say that, or it's going to have a provision saying that adopted children or grandchildren, for example, are not included. So you would have had to have told us how you feel about adopted grandchildren, for example, and we would have put a provision in this paragraph that says those adopted grandchildren or other heirs are either in as far as inheritance or they're out. So that's where we'd say that.
And if you haven't decided that yet, you may be looking at both provisions and you're asked to pick one.
Right. Yeah, and that could very well be you have an alternate provision here, and we'll have noted that probably in bold there for you to make a selection and tell us, so that in your final document, only one of those is there. The next article is entitled Special Needs Trust. In my document, it's Article 9, and yours it may be different. I'm not going to go through every paragraph of this document, or this section. It's fairly long, but I'll just generally explain what this means. Now, first off, if you have a child that is going to inherit, for example, and has some sort of disability, they have special needs, then we will have specifically set up a trust for them that deals with those previously, or we may deal with it here. But it's important for you to tell us in advance if you've got a child or grandchild that has special needs, so that we can properly deal with that. This is kind of like a safety net sort of provision. Basically, it says, you know, we don't know of anybody that has special needs at this point, but later there may be somebody that's going to inherit a share from your trust that does have special needs, and they are, for example, currently on Medicaid or some other public assistance program that looks at how their assets are in order to get them qualified. This is dealing with that situation, and basically says if a beneficiary is going to inherit a share and they are on a government program, then the trustee is not authorized to pay any money to that beneficiary that would disqualify them. Instead, what they're going to do is use the money that's in their trust for anything that program does not pay for. So typically it's luxury items. Typically, you know, someone's on Medicaid, maybe housing might be paid for, maybe food might be paid for, but cable television, for example, wouldn't be. Going on vacation, for example, wouldn't be. Maybe a car wouldn't be. So you're authorizing the trustee to make expenditures for that beneficiary to cover only those things that are not covered by the government program. The goal is you don't want to pay them their inheritance and then have them disqualified from the program. Later, on my document, it's on page 10. Yours is going to be different page-wise because of the provisions you have. But in the last paragraph of that special needs article, we're talking about how this trust property, if it's in this trust, will be terminated and distributed. And basically what we're saying here is when that special needs beneficiary dies or this trust otherwise terminates, then that money is going to go back and be distributed as you set forth prior to this.